Hi everyone, I'm Simon Youel, I'm Head of Policy and Advocacy at Positive Money. I'm a member of the Treasury and Bank of England CPC Engagement Forum, and I was on the Bank of England Offline Payments Working Group. Probably worth introducing what Positive Money is, my organisation, in case people aren't already familiar. So we were formed in the aftermath of the 2008 crisis, mainly to raise awareness of how the monetary system works and potential ways in which it could be reformed post the crash. We've kind of grown a lot since then, growing in staff and our areas. So we work quite broadly across money and banking, including issues around green finance, macroeconomics and inequality, but also digital money being a key part of our work. So yeah, I guess we've been in the kind of, as a non-profit research and advocacy group, we've kind of been one of the forerunners, I think, on digital pound or digital currency. Going back to the early 2010s, we produced a number of papers on the topic, some of which has informed the Bank of England's own thinking on their design of the digital pound. So our founder, Ben Dyson, his paper, Digital Cash, in 2016, was then influential for when he moved to the Bank of England and then designed the platform model, which the Bank of England has, I think that's fair to say, has been the main technical model they've been using for their version of digital pound. But since then we've been doing further engagement with the Bank of England and exploring in more detail what digital pound design options could and should look like, and what the benefits are to the public good. So I mean, I get the impression that there's a reasonable degree of literacy with digital currencies in this room. I don't know if I need to explain what a digital pound is or why it's important, or is it worth me still doing that? I mean, I'll just go ahead and explain why I think it's important anyway. I think, to understand why digital currency is important, I think you have to understand the current monetary system. If you don't, I think you'll get a lot of people, such as the House of Lords, concluded that digital currency is a solution looking for a problem. But, the nature of our monetary system is that it's a public-private partnership, but one which is, I think, becoming increasingly private. It's a multi-layered system where essentially you have public money issued by the Bank of England in the form of reserves and physical cash, the former of which commercial banks have a monopoly on holding, and are able to use that to issue their own forms of money, which the rest of us use, and then using central bank reserves to actually settle the transactions. Public money is the risk-free asset that ultimately is used for settling transactions. And I guess one way to think of it, my friend Brett Scott, I don't know if you've come across his work on money, I like his analogy of kind of casino chips, right? When we're using bank deposits, we're essentially using the casino chips in a casino. It's a claim on money, but it isn't necessarily the same thing as actual money as we think of it in form of cash. And so, as you may know, not many people do, I think. Most of the money in the modern economy is created by banks. There's private money created in the form of deposits when banks make loans. I think only about 3% of money, potentially even less in the modern economy, in actually circulating as physical cash. So why is this an issue? I think, we are to some extent walking into a situation where, I think, as I said, we are increasingly having a privatised monetary system where, without cash being used, increasingly the only way that you can make payments and participate in the digital economy is through banks. And in essence, the public good of the payment system is increasingly entangled with the risky profit-making of private banks. And this is potentially one of the biggest cases of the risk being socialised and rewards privatised. We've essentially give huge subsidy to the banking sector in order to ensure that the money they issue trades on par with cash. And with the absence of cash, there is a concern that there's a loss of public money as an anchor for financial and price stability. I think that's one of the core reasons the Bank of England's interested in it. I think the current bank intermediated payment system is inefficient, it lacks competition and has high costs. You know, banks essentially have a monopoly on payments. If you get paid, you have to essentially lend your money to a bank. Banks are able to capture significant rents from this, both from the payments process, through high fees, but also through seigniorage. The profits from issuing money, which are considerable, have been passed to banks, and that's enabled them to make quite large, substantial profits, which could otherwise be captured by the public sector. I think resilience is a key issue. The kind of multi-layered system which relies on multiple intermediaries, data centers in other parts of the world to make transactions, is vulnerable to a number of threats ranging from tech outages to full-blown financial crises. If one bank goes down, the payment system may go down with it. I think we're seeing increasingly worrying signs in an increasingly uncertain world about the resilience of the payment system and the global economy more generally. People may have seen these kind of threats in the US, where Elon Musk seems to be gaining control of the Treasury payment system. And I think this kind of system we have currently has a lot of single points of failure that can be captured. And I think inclusion is a key issue. There isn't necessarily much of an incentive to provide inclusive payment services when you have banks which don't necessarily have a social mandate. You have privacy issues in that all of the information in a transaction is recorded and can be accessible by state and non-state actors to varying degrees. So recognising that we've kind of got this system which relies on publicly issued money, which only commercial banks have access to, it raises the question: what if you cut out the middleman and give everyone access to central bank money in digital form? And this is essentially what a central bank digital currency is. So it provides combines the properties of central bank reserves as digital, but with the public accessibility of bank deposits, but also the public nature and risk-free nature of cash. So the Bank of England has been exploring this for a number of years. They've concluded that they think a digital pound is likely to be necessary by the end of the 2020s. They put forward a number of reasons for this over the years. I think in my slides I've put down this diagram they have explaining kind of some of the issues, but I think they've kind of focused it more on the two main issues being the singleness or uniformity of money that they want to enable by having access to public money as an anchor, and innovation. People may also say that one of the reasons central banks have explored digital currencies or issuing them themselves has been the threat of new forms of private money, such as stablecoins. So the threat of Facebook or Meta issuing Libra definitely seemed to accelerate interest from central banks and get them up in their game in this regard. And I think it's fair to probably say that either way, even in the absence of the CBDC, we are probably going to see innovation in monetary instruments where deposits are no longer seen as the most competitive form of money for payments, and the question is therefore whether stablecoins issued by private firms which are supposedly backed by public assets, or money issued by the central bank is a preferable alternative. But I would also argue there are other benefits, which we've touched on already, in the form of resilience, financial inclusion, but also that kind of seigniorage. And I've done some analysis myself which suggests that if all of the kind of zero interest bearing deposits in the banking system, which make about 20%, were converted into a digital currency, that would essentially raise between 20 to 30 billion pounds a year in fiscal space for the government through that recapturing of seigniorage from the banking sector. So where are we right now? So I think, as I mentioned, the Bank of England has been consulting on digital pound, mainly on their platform model, which is an account-based model based on people having accounts on the Bank of England's core ledger, intermediated by payment interface providers. And this, so far, I think the project has attracted a lot of criticism. I think it's not immediately obvious to people how this differs from the current monetary system to bank deposits. I think you've kind of got to understand the difference between public and private money to really grasp that. And I think there are concerns over privacy, and this was one of the in the I think 50,000 or tens of thousands of responses the Bank of England has had to its consultation on a digital pound, its latest consultation. Most of the concerns were about privacy, and you may have seen. I think I've got images in my slides. The kind of there's a vocal minority of people very opposed to CBDCs. You may have seen these leaflets circulating suggesting that the government is planning to issue programmable digital currency to monitor all of our transactions and control us, and therefore people are very keen on preserving cash in order to preserve freedom, and also resisting digital currency. So for me, I think if we want to capture the benefits of publicly issued digital money, which I think are large, but also want to provide something that is genuinely useful to the public, I think digital cash is the way to go. So rather than an account-based system, similar to bank deposits, which has been the main way the Bank of England thus far has been thinking about it, moving more towards a bearer instrument, which replicates the key benefits of physical cash. So something that's truly offline, doesn't rely on a core ledger to settle transactions, which has privacy by design, is inclusive and resilient. You don't have those single points of failure that you might have in a ledger-based system, and I think ultimately more efficient, cheaper, giving that kind of holy grail of peer-to-peer payments, which has been ostensibly the goal of technologies like Bitcoin, which was originally marketed as digital cash, enabling peer-to-peer payments without the banking system. But the key issue there is that they didn't have the unit of account that people use, i.e. pounds or dollars. So where cryptocurrency has shown most promise or potential has been things through stablecoins, where you're essentially using the branding of a national unit of account. And to me begs the question of why not just have a publicly issued digital pound. So I think, as Eduard's presentation probably explored, there's huge benefits to particularly for retailers, given the high cost of the system. As I think I showed in my slides earlier, there are high costs to bank payments involving all the intermediaries. The card companies, the acquirers, the banks themselves, all taking a slice of the transaction, which can equate to several percentage points at times of any transaction, which presumably isn't very good for prices and economic growth. The Bank of England has established an offline payments working group, and on that working group we recommended that the Bank of England explore the kind of eCash design as a kind of bearer instrument, which informed by the work of people like Eduard have been doing over the last, I think, 30 years. And we'll be hearing more about next steps on that at the engagement forum meeting tomorrow. But the Bank of England has given a kind of progress update and talked about what is next. They're currently in a design phase, and there are 4 main work streams. So there's the experiments and proof of concept work stream, where they've created this digital pound lab, which will be working with other stakeholders to test innovative use cases and the kind of feasibility of those. There's the blueprint work stream, in which they're trying to actually build a proposed model for a digital pound. So far, they're, I think, in the quite early stages of that. I think they've published a framework for a blueprint, but not the actual blueprint itself. Then there's this national conversation strand, which includes the engagement forum, which we at Positive Money sit on. But I think thus far there are limited attempts to actually engage the wider public. I think there's a lot of scope to be done on, whether you can have a genuine national conversation on the future of money and what that would look like. And then there's ultimately going to be the assessment work stream, which will put forward a framework for a cost-benefit analysis and inform the decision on whether or not to actually build a digital pound. And once the Bank of England has made that decision, there will be a vote in Parliament on whether to proceed, which probably won't be until towards the end of the decade. So I'm not sure how much time I've just spent on that. I don't know if I'm to time or... I think I went through most of the points I wanted to make. I'm not... hope it was relatively clear and...
thanks, Simon. And we'll have lots of time for conversation and dig in.
Good.
So, my name is Eduard de Jong, although in England I'm Edward. That was easier to pronounce. My career, I started as a physics student and then I switched over to computer science with some political career in the middle. In 1990 I joined a company in the Netherlands called DigiCash. And in 1991 I was in London at a trade show showing the first fully offline electronic payment system ever existed in the world. It was a vending machine where you could use a smart card and get a coffee out of the vending machine. So we convinced the vending machine seller to loan us a machine, and we changed their money acceptance thing. We had a small car driving around and showed you could pay at a fast, very high speed, like sub-seconds we were using for toll roads. 1991 is a seminal year for e-cash systems. In Finland and in Denmark and also in the UK, initially started to doing in the e-cash system. In Finland it was the central bank doing it. There's a paper from the guy involved explaining how that worked. In Denmark it was the post office and the telephone company which were looking at it, and it is public transit and post and cell phone, no, not cell phones, public phones that were driving force to get this development. So the picture that I have, the first one, is the badge that I wore at a trade show in London, which actually was used and had money in it. And so it was, the privacy protection in this system was very clear based on the patent from David Shawn, the founder, cryptographer founder of this company. And he's renowned for this thing, and he's still working on these things. So that's all 30 years ago. E-cash is a digital form of money. And so the question is, what is actually money that to be digitized? And of course, if you are in a bank, you saw it's just a number in my ledger and database or whatever. But if you want to go to the basis, and as a computer scientist, that's what I did. You go see, it's information. And it's particular information about a person and his capability to actually pay off a debt. And the debt you get when you take something out of a shelf in the grocery store, then you have to pay for that what you take out. So that's a very simple model. And of course, with being information, you have two questions to ask: how is it encoded, and what is the information processing on it? Now, the nice thing about money is that it has only one process, which is payment, which is meaning that if the money I have and the money that you have changes as a pairwise operation. What I have and I make a payment is less and you get more. That's the basic operation. And the nice thing is it has a very nice property. There's no money lost or no money gained, so the sum total of both monies before and after the transaction is the same. That's a very nice precondition or post-condition you can image or put on any information processing system. Then of course it has to be encoded. The nice thing is, if you know it's always bits, and so you can say bits are just there. The other thing that you have to realize is the ownership is there. Only an owner can make a payment. So in order to make that digitally happen, the ownership has to be part of the digital form of the money. In the physical money, ownership is very, very clear. You have it, or you don't have it. And if you have it, you own it, and you can give it out to someone else to have it. And encoding is then the question: how works encoding with solid cash? Well, very simple. There's this concept of unary encoding, which means counting. The number of sheep in a meadow is a unary number. You just start from one and then you have to find the total number. You can write it down in another form of encoding. So coins, banknotes, can be enumerated for the amount you have. And since they have each their own unit value, you can sum up those things and you have the amount. And it's a multi-level encoding scheme, as they call it in computer science, where you have different number bases. You have normal. The UK had a very interesting numeric system. It's you have base 4 for the. Then you had base 12, and then you had base 20, and then so all those things all different modern systems, they are actually explainable just as a mathematical notation concept of encoding schemes. So that's where we have. That's how I approach money. Then, if you look at digital form of money, and you compare it with the that's the slide with the nice colors on it. There are only two parties involved in that transaction. And the key concept is that there's no cost involved because there are only two parties involved. In the digital form, you see that the payer can still be that one person giving money out, but the payee has to give information about where it has to go. Otherwise, it can go everywhere. So you have to get information about the to that device which the payment makes. Which doesn't need to be a full identity, it can be just an identifier which is unique. And that's recognized by the device by the payee to actually accept the money as use it to spend it again. So eCash and cash are both identity-free money systems, which is completely different from all the other money systems which are recorded. Information with the identity, an identity bank account number and a bank account with some address and other information. Or if you are the blockchain models, they're always associated with some ownership from public key or whatever. So in a digital system, the e-purse, the device that you have, is the key component. It holds the money that you can spend. It holds also the cryptographic component that allows the spending to be secure. Oh, okay. Then we go to the next one. So then we look at what components do you need to have in the system that makes e-cash payments. And there are actually only two components. There's a money holding device that anyone that accepts the money has, and that can be anyone that can be. It can be a bank, it can be a company, it can be a person, it can be a family, whatever entity wants to spend electronic money has a device. And what emerged in all those years of looking at this system, on and off, is that there are really two design domains. The domain of money, where you want to make sure that money is accessible to everyone, so you can have public money with it, that anyone can use it, and where and when it is needed, and to the amount that he wants to pay. That's the money aspect of the system. That basically emulates completely what solid cash can do. It improves on solid cash since there is no volume involved in paying. So if you want to do £1 million in pounds, that's a big truckload full of pounds. But if you do it in digital, it doesn't change from 1 penny to £1 million. It's the same amount of information. There may be some difference in the security and the keys that you can, but that's like a detail of the process, not of the fundamental action of paying. You can still pay that $1 million offline to someone else, if they want to accept it, of course. They can say, well, I don't want it right now. So we also know something that don't work. The thing that doesn't work is tokens that are stored offline. This is what DigiCash built in that first slide that had a system that created kind of tokens. And you can't keep tokens secure, because tokens have no identity attached to them, because they are anonymous normally, at least in some forms. There's always copyable. There's always double spending. So in order to prevent the problem of double spending, you have then to add a lot of complexity, and the nice separation between security and money disappears. The other thing that doesn't really work is doing a balance transfer. So I have a balance, and I take out some money, I make a message, and give it to the PE, and the PE says, "Oh, this is nice, this is good knowledge, I'll accept it." That message can get lost. And then there is the problem of known as consensus in computer science. Both devices can claim, "I paid you," and others say, "I didn't get it." And there's no solution possible for that sort of thing, unless you do record the fact that the payment has attempted and that the payment has not arrived, which is what the systems like in Hong Kong the person is doing, and what Mondex, the UK system, try to do in order to make sure that their message that had money could be detected, and then the losing party could be compensated on the bank account. So that was a money system that was based on a bank account. eCash is a money system that is not based on any account, you just have it with you. Of course, a bank can have an e-purse, so you can make a transfer from your bank account to your own e-purse, or you can make money from your e-purse to your bank account through the e-purse of the bank.
Right.
That's there's no difference there. So then we come to my last slide, which is about what I see as the main ingredient of what we would like to work on in this project is about public money, and especially the digital public money infrastructure. How does it work if everyone has a purse like that? What is the legal context of owning a purse? Who is responsible for the content, and who is responsible for payments when they fail, etc. There's, technical failures. Those things need to be understood. The purpose, I think, is there's benefits of identity money, and society can use it because it reduces the amount of money spent on payments. A lot of people earn their money at banks, and a lot of people get income and profits from those things. If you have an e-cash system, that's very fundamentally different. So you have to think what it does to society and how to get it there. It's clear that merchants, as Simon already said, would be very interested because they pay. I spoke to large merchants in France the other day. They pay millions a day because they get so much money. So if they can get 10% less money, it's already a profit for them. So it's getting the scope right of the product. And if you look at the Bank of England, it's their offline model. It's for small payments, incidental payments. And it's not for real money. It is play money. It's the kind of play money that actually used this technology, which was 8 years ago in the Balloon Festival in Bristol. The company based here in Manchester implemented this technology for private money, for events. But we were behind, I was involved there, and we were behind the curve of events and event money. Account-based money was already taken over there. And so we were too late, about 3 years. Earlier we would have been in business there as private money. Now we're looking at digital CBDCs and their need for digital money. And this, in my view, is the only option they have, is to really go thick. But it is also, it has political consequences. It's not just trivial to do technology. It is really about what does it do to society. It's deep privatized payments is the word I use. It's not, they're completely privatized now. I mean, apart from the few that are in solid cash.